my last slide, the central bank would do very little. So it wouldn't do as much as what we talked about in the Uruguayan proposal, where the central bank actually runs technology. Here, the central bank just grants a license, verifies that reserves are 100% backed for the stablecoin, and that would generate the trust that is needed for the digital cash to be a true digital currency. And then everything else would be done by a fintech firm. Good morning. Let me start you off with an important question. How are you going to pay for coffee? When you travel around the world today, you can pay for coffee with cash or with debit cards. But if you travel to China, you can pay with Alipay, or in many other countries with WeChat Pay. Elsewhere in the world, for example, in the US, you can pay with US dollar coins or with Gemini. We just heard the proposed currency Libra, which might be available all over the world. And another currency is Paxos Standard. So there's a variety, and this is just a very small sample of the possible forms of e-cash that is in existence today. There are many, many forms of e-money that exist around the world today. So how do we think about all of them? How do we classify them? What's the conceptual framework for all of this? So let me start off with a framework for how to think about digital monies. And this is what we call the money tree. So in the money tree, we distinguish by type, value, backstop, and technology. So let's get started with the traditional debit cards, checks, and wire transfers. So these are claims that have a fixed value. So if you use your debit card, if you use a check, you know exactly what the value is of your payment. And typically, those payments are backstopped by the government with a discount window, because this is done through commercial banks that have discount window access, and they typically have deposit insurance. Furthermore, it's a centralized system. New forms of cash and digital cash typically don't have the government backstop. So many of the currencies that I showed you in the former slide have a fixed value, but they have a private backstop. So this is what Hyun was referring to when he started off talking about stable coins. And then there's a distinction between centralized and decentralized systems. So centralized systems are things like Alipay in China, where you have an account-based system, and WeChat Pay and M-Pesa in Kenya is like that. So these are account-based systems where payments go through a centralized node. And then there are the decentralized systems that Usman was talking about when he was talking about ledger systems. So for example, the US dollar coin is a distributed ledger technology that is a token that is completely decentralized and is based on DLT technology. In addition to that, there are forms of digital cash where the value is actually not guaranteed, where there are fluctuations in the value of your coin, and those are typically decentralized. So, for example, there are gold coins you can use today that are decentralized, and where the value of your currency fluctuates with the price of gold. And Libra is a proposal where actually the value of your currency is not fixed. It fluctuates with exchange rates, and it potentially fluctuates when interest rates are negative. So this is the money tree. So that's a conceptual framework to think about all of these different currencies. Now, what are stable coins? So what we think of as stable coins are decentralized forms of digital cash. So that would include things like the US dollar coin, where that's a stable coin that has reserves, where the reserves are held at a commercial bank, and then every single stable coin is backed by one of these dollar reserves at a commercial bank. Or it could be something like Libra or the gold coin, where basically the reserve is held in a basket of assets, such as an investment in a gold ETF or some sort of commercial paper and government paper in a reserve fund, and then the value of your coin is fluctuating with the value of the reserve fund. So that's stable coins. Now, do you think that stable coins are going to be adopted? So does it matter? So fine, there are perhaps a couple of thousand people out there that are using these stable coins, US dollar coins. I don't know anybody personally that uses them. I know one person. But is this going to be adopted? Who's using Bitcoin to pay for coffee? I don't know anybody. So is it going to be adopted? And so what we're thinking of here conceptually again is that, number one, you want stability of the store of value. So having a cash-like instrument that fluctuates in value might not be that useful. And secondly, you want to have attractiveness as a means of payment. So is this stable coin integrated into our digital lives, right? I mean, sure, we have cash, but the future is digital, and we want to pay digitally, right? We want to pay from cell phones, as we just heard in the case of Uruguay. So stable coins are not necessarily a stable store of value. And that's because there is a variety of risks, right? Stable coins are a claim with a fixed value redemption that is privately backstopped. And so because it's a private backstop, there's counterparty credit risk, there's default risk, right? Like the company that you're interacting with might go bust. There's market risk in the case of things like a US dollar coin, things like a gold coin or Libra. There's potentially FX risk with Libra, and there's liquidity risk because the reserves might not be fully liquid. A variety of risks. Yet there's some adoption of these stable coins even today, because from the point of view of attractiveness of the means of payment, they're actually pretty good. They have low transaction costs, they have global reach, they're interoperable and have complementarity with today's technologies, and in some countries around the world, actually fintech companies are trusted more than banks. Furthermore, there's convenience. You can use your phone to pay with everything. You don't have to have a wallet and credit cards and all of this. Everything is done through your cell phone. There's one device that does it all. It connects with your friends. It calls to your family, and it pays for whatever you want to pay for. And of course, there are huge network externalities. And the network externalities is one of the main features that has come into the debate with the proposal of Libra. Now, I would argue they are not just private advantages. They're not only advantages potentially for you and me, they're also public advantages from a policy perspective. Number one, there's more competition. We like competition. Number two, there's potentially more efficiency because the new technologies are extremely cost efficient. Writing code, from what I hear, writing code to create a new currency is something like 2 or 3 lines based on the Ethereum technology. There's the potential for financial inclusion, which matters a great deal in the majority of countries around the world, where access to payments technologies, bank accounts, is still very low. And of course, there's innovation. We like innovation. As economists, as central bankers, as policymakers, we like innovation. Innovation is good. So cash is a very good store of value, but it's not that attractive as a means of payment. Deposits are more attractive as a means of payment because they are digital, and the usage of deposits is much larger than the usage of cash around the world. And then there are the stable coins, which are potentially more attractive, but for the moment are not as stable. So I talked a little bit about the private risks of stablecoins. So the risk of you as an end user of using stablecoins. Now, what are policy risks? So from a welfare point of view, what are risks of stablecoins? And there are many. So these are the big policy questions that central bankers are asking today. There's a risk of disintermediation. So it could be that deposits are going away from commercial bank deposits into stable coins, so that maturity transformation in the banking system is no longer conducted. There's the problem of market power. If a company like Facebook enters into the payment system with 2 billion users, it has a potentially huge market power that can be used in all kinds of ways. There's the consumer protection question. If, again, Facebook was operating Libra, it would suddenly get data on payments and could connect this data on payments with data on social network activity, and how that would be used is a big consumer protection question. There are monetary policy questions, particularly for countries with weak monetary systems. Dollarization, or rather stable coinization, might become much more prevalent and much more dangerous. It's much easier to adopt a digital currency in a country with a weak monetary system than to adopt cash transactions in dollars. So the potential for undermining monetary authority is tremendous. There are financial integrity questions that were already alluded to. Are these transactions traceable? And finally, there are financial stability questions, which is about run risk. So one of the striking things that we have seen since the Libra proposal, which only started 2 months ago, is that central banks are taking central bank digital currency a lot more serious today. So Uruguay was at the forefront, and Sweden were at the forefront of thinking about central bank digital currency already for a number of years. But with the Libra proposal, actually many more central banks around the world are thinking about central bank digital currency because they see the threat of the monetary system being undermined by private stablecoins. So what I want to talk about in my last couple of slides is about a proposal of synthetic central bank digital currency. So in our views, financial stability is at a crossroad. So you could go into one direction where you have stable coins that are regulated in one sense. So stable coins are created already. We heard that the private marketplace is generating hundreds and thousands of proposals for stable coins. And you can try to regulate a shadow banking system of stable coins. That's one way to go, and it's probably going to be a lost battle. There's the other way to go, which is to create what we call synthetic CBDC, which is to allow special purpose licenses where stable coins can hold reserves at the central bank, but where the central bank is not itself necessarily involved in the technology part, as we heard in the case of Uruguay. So this is a narrow banking proposal. So this is a proposal to grant special purpose licenses for banks. In Hong Kong, there is something like that called a virtual banking license. In Switzerland, there's a fintech license. The Bank of England is considering such a fintech license as well. And in India, there are payments banks. So narrow banks that could issue stable coins, that could operate a distributed ledger technology, all kinds of token-based technologies. It could be an account-based technology. But it would have the ability to hold the reserve with the central bank. That would be presumably a 100% reserve requirement. And so there are a host of advantages of such a narrow bank. It would ensure stability, because now you know that the stable coin that you're using is fully backed by reserves held with the central bank. So there wouldn't be the run risk that Hyun was talking about. It would be interoperable because presumably the private operator of the stable coin would have incentives to have interoperability, and the narrow bank could be plugged into the RTGS, the real-time gross settlement system, whatever payment system is existing in the country. There would be regulatory clarity because this would just be a banking license, so it would be regulated like a bank, but a very, very simple bank, because the very simple bank just has assets, which are reserves with the central bank, and liabilities, which are the tokens that are issued. It would rival the FX coin, so it would push back against the danger of the monetary system being undermined by the presence of US dollar stablecoins or Libra coins that could undermine monetary stability, and it would thus preserve monetary policy independence in your country. So basically, and this is my last slide, the central bank would do very little. So it wouldn't do as much as what we talked about in the Uruguayan proposal, where the central bank actually runs technology. Here, the central bank just grants a license, verifies that reserves are 100% backed for the stablecoin, and that would generate the trust that is needed for the digital cash to be a true digital currency. And then everything else would be done by a fintech firm, or it could be a traditional bank, right? A traditional bank could have a stablecoin subsidiary. That would be a simple segregated account that would just do one thing, hold reserves for the central bank, and then operate some form of tokenized payment system. It could be a telecom operator. It could be a startup. That doesn't matter so much. What matters is that the central bank just has to be in the business of doing what it's best, which is to grant a license for a bank and then verify that the bank is doing what it's supposed to do. So all the technology would be left, the innovation would be left up to the marketplace. Finding solutions would be left up to people like Usman. So this would be very, very close to really holding a central bank liability. So we call it a synthetic central bank digital currency, because you don't directly hold a central bank liability. There's still one balance sheet in the middle, which is the one of the narrow bank, but it's very, very close, because all the narrow bank holds are central bank reserves on the asset side and stablecoin liabilities on the other side of the balance sheet. It's simple, it's cheap, and it's a private-public partnership, which we're generally keen on. So it's something very simple to do. It solves a policy problem, and it solves the problem that is currently in the marketplace, which is to generate stable coins that are really safe and really trustworthy is difficult. With a synthetic central bank digital currency, you would solve all of these problems.